Morning, this is Andy Hill speaking of Andrew Hill Investment Advisors, and today is August the 2nd, 2013. This morning, the employment report was released by the Labor Department, which showed that growth in employment was a bit less than expected, with 161,000 jobs created in the month of July. Expectations were about 180,000, and that compares to growth of 191,000 in June. The unemployment rate, which many economists and politicians look at closely, dropped to 7.4%, and that was largely due to a reduction in the labor force participation. One could probably surmise that if you lost your job recently, you may want to consider taking off the summer before you regain your employment search. Overall, with the report being a bit less growth orientated than we had hoped as investors, it's a minor negative for stocks that may give equity investors pause in light of the 5% run-up in the month of July. It may give bond investors a bit of hope, given that the bond market has been devastated since the Federal Reserve began its comments about tapering or reducing their bond purchasing program back in May. Touch on the bond market in a minute. Earlier this week, I tried to get out a report on the muni bond market, which the technology got a little bit mumbled. So I'll just give you the highlights of what we were looking at. Of all the fixed income markets that have done very poorly so far this year, the muni market has been the hardest hit. Pressure certainly came as a result of the Federal Reserve making comments towards changing their policy towards supporting the bond market as the economy has improved. The next issue that hit specifically the muni market has been the Detroit bankruptcy. Well, it's obviously was greatly expected that sooner or later Detroit would file bankruptcy. The implications to other municipalities is the real issue, and that's being the focus as to how bondholders will be treated in the Detroit bankruptcy. And the concern is that bondholders may not be treated fairly. So that's the issue that's impacting investors in munis right now, and that has led to a significant outflow of mutual funds focused on the muni market. Last week, Barron's reported that $2.9 billion was withdrawn from municipal bond mutual funds, and I believe that it was well over about $10 billion over the last month. So that market has been particularly hard hit, which creates the opportunity. First, yields on municipal bonds, and as most investors know, municipal bonds generally are free from income tax implications, are trading at higher yields than treasuries. Given the comparison of a high quality municipal bond to a treasury bond and the opportunity for not paying income taxes, that is an abnormality that usually doesn't last too long. Closed-end funds, which we have a few in most client portfolios that can benefit from the income tax opportunity in munis, have been particularly hard hit, and this isn't anything new. Municipal bond closed-end funds tend to be a little bit more aggressive than traditional open-ended mutual funds, and they always get punished the worst whenever there's a whiff of danger in the muni market. And the great irony of all this is that this year income tax rates are higher, especially for those in the top tax bracket. And despite that, munis have had a very poor year, which creates an opportunity. Just want to switch over to a brief comment on our overall asset allocation. And for clients that have been with us for some period of time, generally we're over allocated to equities, but under allocated to fixed income, which has led to an over-allocation in cash, which we're really targeting to purchase bonds once we can get some support coming into the bond market. That may come around the time when the 10-year Treasury bond, which is the benchmark everybody looks at in the fixed income markets, gets up closer to about 3%. Right now, it's around 2.7%. So we're getting close, but we aren't quite there. I think that's a significant benchmark. Just like in the equity market, where the S&P going through the all-time highs of around 1,600 was particularly significant. So with that, been very busy in the office lately with earnings reports, and next week we'll start getting back on to setting up client meetings. So anticipate a call from our administrative assistant Diana to set up a visit with us to discuss the performance for the second quarter and our outlook for the rest of 2013. Thank you as always for tuning in.